Well, welcome to our clients and other listeners on this rather chilly Tuesday afternoon in Toronto. Thanks for taking the time to tune in to our weekly webinar where we will talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategy. So sit back, relax, perhaps grab a glass of wine. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I am joined on the call by my partner and colleague, Paul Tepsich, the founder of HighRock. Our financial planner, Bianca Tomlinson, is also on the call. We'll have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask questions. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About HighRock tab. Well, what's happened since our last webinar? Let's start with our top trending Google searches for last week, like we do almost every week. Last Tuesday, one of the most exciting rugby players of all time, Jonah Lomu of the New Zealand All Blacks, passed away. Well, on Wednesday, the top search was former CFL and NFL quarterback and now sports commentator Doug Flutie. Thursday, Josh Donaldson and Elon Musk shared the top search, were tied at the top level. On Friday, Mali and the latest terror attacks were the top search. Saturday was the classic soccer matchup between Barcelona and Real Madrid, and Sunday, the American Music Awards. Yesterday, it was time to think about Black Friday, and the sales at Best Buy were the top search. This morning, Turkey shot down a Russian bomber that apparently had violated its airspace. Russia denied this was the case and has said that there will be very serious consequences. So add a new twist to the geopolitical uncertainty along with the Paris and Mali terrorist attacks, and we add yet another layer of uncertainty on top of an already uncertain economic environment. Traders and investors do not like uncertainty, and they tend to move out of riskier assets into safer assets until they feel more comfortable. Well, this is the ability to push volatility levels higher. Well, Google searchers are not much interested in financial markets, so let us fill in what's been going on since last Tuesday. U.S. and Canadian bond markets were a little bit stronger on the, or earlier in the week they were weaker, but recovered over the last few days as uncertainty levels increased bond buying. Some selling is still driving preferred share markets lower. Canada and U.S. bond spreads in the 10-year area widened to approximately 63 basis points over the course of the week. The World Equity Index was higher by about 1.5% over the last week at this time and is now ahead on the year as a whole. Australia's All Ordinaries Index was the best performer on the week at plus 2%. The French CAC 40 was the weakest performer at down 2 and close to 2.5%. The World Equity Index, the benchmark World Index, currently at or about 58, at a price of 58, found selling resistance near the downtrend line last week and should likely now look to find buying support in the near term, where it found that support last time at about 56.5. If it finds support, it will likely try to retest that downtrend line on the upside at or about 58.5. However, failure to find support will likely result in tests of lower support points near 53 and below that at last August lows of between 50 and 51. Oil tested its lows earlier in the week but bounced higher today on the geopolitical issues, and that gas was hit rather hard on the week before copper touched $1.99 yesterday morning before bouncing back to be down slightly since last Tuesday at around a price of $2.07 right now. The Bloomberg Commodity Index was slightly better on the week, but is still near its multi-year lows. Volatility has slipped back to its longer-term average despite increased geopolitical turmoil, and it remains well below the levels from late August and early September. Well, the U.S. equity markets represent 52% of the world equity index, so let's check in on what's happened in the U.S. economy over the course of the last week. Minutes from the October Federal Open Market Committee meeting released last Wednesday suggested that the Fed was ready to raise rates at the December meeting. It was really no surprise, but it did continue to suggest that longer-term interest rates will remain lower for longer. Also, no surprise. But equity markets continue to like cheap money despite problems brewing in credit markets as debt levels continue to become more problematic. And I'll talk about that a bit more in a few moments. Remember that the Fed wants to see some indication that inflation will be returning to the 2% level. They may have it now with wage inflation starting to appear. They'll let us know more on December the 16th after they finish meeting. In the meantime, U.S. third quarter GDP was revised higher this morning from 1.5% to 2.1%. However, behind the scenes, much of this revision can be attributed to a buildup in inventories. Also, consumer spending was revised down. Something we've been watching closely, and I mentioned it on BNN a couple of weeks ago and in our last couple of Tuesday webinars, is the relationship between rising inventories and weakening sales. Historically, a rising ratio of inventory to sales has been correlated to past recessions. Now, we'll monitor this relationship very closely as we go forward in time. Consumers had been confident up until recently, while consumer spending on retail purchases did not respond to that confidence. Now, however, with today's latest data, consumer confidence is slipping to unexpected levels. The decline in job expectations was quite dramatic and raises the question whether global effects, which have been negative for the U.S., are beginning to weigh on the American consumer, which would not be a positive for the holiday spending outlook. Around the global economy in the euro area, which represents approximately 16% of the world equity index, minutes from the last European Central Bank monetary policy meeting showed that current monetary policy measures would need to be re-examined in December as negative risks to inflation have increased and some external forces are offsetting current central bank stimulus. Well, Japan is 8% of the world equity index. Last week we reported that the Japanese economy had slipped into recession with negative growth in the second and third quarters of 2015. At last week's meeting, the Bank of Japan kept its pledge to increase the monetary base at an annual pace of about 80 trillion yen at its November 2015 meeting. Policymakers said the economy has continued to recover moderately, while inflation is expected to be about 0% for the time being due to falling energy prices. Risks to the outlook include developments in the emerging and commodity exporting economies, the prospects regarding the debt problem and the momentum of economic activity and prices in Europe, and the pace of recovery in the U.S. economy. So lots of things concerning the Central Bank of Japan. In China, which is 2.5% of the world equity index, the unofficial purchasing managers indices for manufacturing and services sectors both declined, snapping increases in the two previous months. The manufacturing PMI declined to 42.4 in November from 43.3 in October, while the non-manufacturing reading fell to 42.9 from 44.2. According to reports jointly compiled by China Minsheng Banking Corp and the China Academy of New Supply-Side Economics. Numbers in this PMI below 50 signal deteriorating conditions. So that is also continued concern for the future of the Chinese economy. Well, in Canada, which represents 3% of the world equity index, consumers took a break in September, reducing purchases by approximately 0.5%. And October's inflation data showed that outside of lower gas prices, year-over-year core inflation remained close to the Bank of Canada's target rate at 2%. Much of the increase can be attributed at the moment to the weakness in the Canadian dollar. Okay, so what do we see coming on the horizon? Well, we look to the bond markets, which tend to lead other financial markets. So what are bond markets telling us at this particular point in time? The longer end of all major developed economic yield curves, government yield curves, flattened as bond investors further reduce their expectations for economic growth and inflation. Now, some economists have suggested that bond investors are underestimating future inflation. However, history tells us that bond markets are usually better at predicting inflation than economists have been. In Germany, bond yields at 6 years and shorter remain negative, and in fact fell to further negative levels as it is expected that the European Central Bank will add further monetary stimulus to the euro area economy in the not too distant future. While there continues to be a wide divergence between high-yield bond prices and the S&P 500. Historically, high-yield bonds have led equities, but usually move well in advance of equity markets. Earlier this year, high yield began to turn lower, and equities followed in August, but have bounced higher since. Now, we expect that U.S. equities' next move is lower to catch up with high yield. For us, this situation raises caution flags. Now, further, as I mentioned earlier, credit conditions tightening and with debt levels rising, the value of secured loans are plummeting as liquidity in this market is drying up. Now, this is raising the risk levels of loan portfolios at financial institutions. This is something that equity market participants have either been ignoring or just haven't realized the potential consequences of. Back in 2008, it was this kind of liquidity squeeze that brought down institutions like Lehman Brothers. So certainly more yellow flags for us. Well, we remain convinced, as we have for quite some time, that equity markets are expensive, a topic that we've talked about for the last few weeks, and a question in our question and answer period last week focused on the impact of share buybacks, where companies use excess cash on their balance sheets to purchase their own shares, driving up the price of shares by reducing the supply and overstating per share earnings. Share buybacks last peaked in 2007. They are certainly peaking in 2015, and we know what happened after they peaked in 2007. Well, last week, an article in the Wall Street Journal focused on this concern and highlighted a number of companies who have driven their share prices higher with a lower share count. For example, Microsoft turned a decline in total earnings into a per share gain by repurchasing a little more than 3% of its shares in the past 12 months. Its total third quarter earnings were down 1.3% from a year earlier, but per share earnings rose 3.1% according to FactSet Earnings Research. Now, also in a letter this year to companies in which BlackRock, the owner of iShares, invests, Larry Fink, the CEO, wrote that more and more corporate leaders are taking actions that can deliver immediate returns to shareholders, such as buybacks or dividend increases, while underinvesting in innovation. Now, skilled workforces are essential capital expenditures necessary to sustain long-term growth. Well, we've made a point of bringing this to the surface over the last few of our webinars, but it's really nice to see that there is some press and media coverage starting to bring this to the public's attention, and we think that this will certainly be impactful over time. Well, for the third quarter of 2015, companies are reporting year-over-year declines in both earnings at negative 1.6% and revenues at negative 3.9%. Analysts do not currently project earnings growth and revenue growth to return until the first quarter of 2016. In terms of earnings, analysts are currently predicting a decline of 4% in the fourth quarter of 2015, followed by a growth of 2.3% in the first quarter of 2016. In terms of revenues, analysts are currently projecting a decline of 2.9% in the fourth quarter of 2015, followed by growth of 3% in the first quarter of 2016. For all of 2015, analysts are projecting earnings to decline by 0.4% and revenues to decline by 3.3% year over year. The 10-year average price-to-earnings ratio is 14.2. Currently, the 12-month forward price-earnings ratio is a well above average 16.4. For us, this makes stocks look very expensive. And the other metric that we like to look at, the enterprise value to earnings, S&P 500 companies are valued at current market prices 12.5 times. The 10-year average is 10.8 times. And as we've mentioned on previous calls in our tactical growth model, we really don't care much to buy anything over 8.5 times. Well, traders and investors who borrow on margin are reducing their borrowing against owning equities. This was indicative of significant equity market selling to come back in 2007 and certainly raises red flags for us at HIROC. Just one more reason for them from the many we have identified for us to keep a greater weighting of cash in our equity models and in our portfolios. Cash is, to us, a defensive asset, and as we explained in detail last week, we think it prudent to have a more defensive strategy, waiting for better value to purchase assets that we believe are currently overpriced. What does all this mean? Well, I suggested on BNN's The Close with Michael Hainsworth a couple of weeks back that I did not see a Santa Claus rally for equity markets. Well, I'm going to be back on the show on December 16th, which is also Fed Decision Day, to face the music. So tune in to see if I have to talk my way out of a tight spot or not. Well, we still believe we're in a low return environment, part of the cycle where global debt levels are high. The global economy has been slowing. Central banks are moving in different directions, and we can expect volatility levels to increase as uncertainty becomes more prevalent. Overvalued assets like expensive equities will experience a correction to more reasonable price points, at which point we will start to look at potentially making purchases as value returns. Well, our discipline, as we've talked about before, is to protect our and our clients' capital in times like this. We're not alone in this thinking. We get credibility from other well-respected economists who agree with our view. Cash and cash equivalents are important defensive assets. We cannot stress this enough. So we are carrying greater than normal cash balances in our models and waiting for asset prices to get more reasonable, to more reasonable price points before we commit our and our clients' capital for the long term. Well, what's up next week? We're heading into the U.S. Thanksgiving holiday in a couple of days. It's usually a time when markets tend to see a little bit lighter trading activity. On Wednesday, tomorrow, we're going to see the U.S. October core PCE price index, U.S. October durable goods orders, and personal income and spending. On Thursday, U.S. markets are closed, but we will get Japanese October inflation and Japanese October unemployment. On Friday, we're going to see the third quarter UK GDP, as well as Euro area November business and consumer confidence, and Euro area November economic and industrial sentiment. Nothing much on Monday, but on Tuesday we're going to get a peek at how the third quarter GDP has turned out for Canada. Well, that's it for today's discussion. If anyone might have a question, this is the time to chime in. Sounds like everybody's probably already off for the U.S. Thanksgiving holiday, so if you do have questions and wish to email us, we are always more than happy for you to do that. We love to get your feedback on these webinars, what you think you'd like to hear us talking about on these calls, making it worthwhile for you, our listeners. But that's it for another week. I want to thank you all for taking the time to tune in. Have a great rest of the week, a happy and safe Thanksgiving to our U.S. friends, and a wonderful weekend. We'll be back with another report next Tuesday. This is Scott Tomlinson signing off.